This is the second quarter update for the Amplify CWP Enhanced Dividend Income ETF, symbol DIVO. We're speaking with Kevin Simpson. Kevin, what are your thoughts on the equity markets the first half of the year?
Jay, to say the first half of the year is an unusual start, I think would be the understatement of the decade. I mean, what we've seen here is just an incredible bifurcation of the markets. We're seeing a handful of big mega cap tech companies leading a rally like we've never seen before. And there's no breath to the market. Everything else is really just kind of hanging around as it had been for most of 2022. Ned Davis did a really interesting study, and it took the S&P 500 and it broke it into two categories: companies that pay dividends and companies that don't pay dividends. Those that don't pay dividends were about 100 names. The dividend payers were about 400 names. The 100 non-dividend payers were up in the first half of the year 18%. The other 400 stocks were barely up, just under 4%. And that really tells the whole story right there. I mean, it is a market that is led by mega tech, catching an AI trend, and to the extent that there's a lack of breath, again, understatement of the year. And that's really been the performance that we've seen out of DIVO, which is, again, high quality, blue chip, dividend stocks that for the past year and a half have really just tread water. You know, thank goodness we do own Microsoft and we do own Apple in the exchange traded fund, and it's allowed us to post a green number year to date. And I think at some point we'll see a catch-up trade. I think we'll see maybe the big tech being a little bit ahead of their skis. Maybe that acceleration slows down and the rest of the market catches a bid and starts to catch up with them a little bit, which would be wonderful for the second half of the year. But boy, if you told me that we were going to see a NASDAQ up to the extent that we did and an S&P up to the extent that we did, and a lack of participation outside of a handful of names, I would never have seen it coming.
So how has the recent inflation data influenced your thinking about the markets today?
I think you can start to get a lot more constructive on the future of equities on a broader scale. You know, the CPI this week was very, very good, comparatively speaking. Even more importantly, core CPI and super core was down, and that's what the Fed is looking at. You really need to see an abatement. You want to see a disinflation take place, and that's happening. Growth has not gone away. We're seeing inflation drop a little bit faster than growth, which is the soft landing scenario, the perfect scenario. I don't think it changes the Fed's decision on rates for July. I still think we're going to see a 25 basis point rate hike here, but it may allow the Fed to back off and rest again, pause, stop maybe. And even if they don't, because the labor market is resilient, they don't just look at inflation. They're also looking at the labor market. And I think they'd really like to see a 4 in front of that unemployment number, and jobless claims probably having a 300,000 figure instead of 200 and change. But to the extent that they want to push further, then you're looking at only one more 25 basis point rate hike after that. So we're closer to the end than the beginning. We don't know when they're going to start cutting rates, probably a 2024 scenario, either because they drove us into a mild recession and a need to re-stimulate the economy, or because they navigated the soft landing and they can pat themselves on the back, job well done, and you can start lowering rates. But either way, we can be constructive on the fact that lower rates are going to be good for equities. And I think the inflationary data, Jay, really supports that.
Kevin, when you look back on the second quarter and you think about the DIVO portfolio, what changes do investors need to be aware of?
Well, I think the biggest thing with DIVO is we do the same thing whether the markets are up, down, or sideways. And I always say that investing is easy, Jay. You buy good companies that make money and who distribute it to shareholders. And that's what we look for. But investing from the standpoint of the retail profile can be tough, especially when you see a handful of companies doing as well as they are. You tend to want to not miss out. So sometimes you chase those trades. And what we've been doing within DIVO is that we've been trimming, taking profits in Apple, taking profits in Microsoft. It's still a 10% weighting, 5% each in the portfolio. We're not abandoning the names by any means, but we're selling into strength to raise some capital. We're writing covered calls to generate cash flow. We're collecting handsomely tons of dividends. And what we're doing is we're distributing those assets into underperforming stocks. So essentially, we're trying to sell high, buy low. And we're looking at companies that are under a little bit of pressure that since their last earnings report have traded down 10, 15, 20%. Coca-Cola, UPS, these are companies that we really like right now. Starbucks, maybe doesn't have the lowest multiple in the world, but relative to its history, it sure does. You don't wait for China to reopen and everyone to start drinking coffee again to buy the stock. You buy it now when it's a little bit under pressure, down 15% since earnings. It's a name we've owned in the past in years gone by, but looking at opportunities here for things that are under pressure. UPS, you want to be looking at it before they either settle in a big way with the Teamsters or the Teamsters go on strike. And you don't want to wait for that strike to settle or to be avoided. You don't want to wait for the fourth quarter holiday season to be a blowout. You want to buy the stock when it's down and under pressure. You're getting a 3.5% dividend on UPS. Over the past 5 years, they've increased their dividend on average by 16%. I mean, these are the things that we really look for, but certainly they're out of favor right now. Pepsi had really good earnings today. We're in Coca-Cola. Maybe it can follow suit, and we'll see good results out of these names. But for the most part, these companies haven't been the movers and the shakers, and we think that they will be moving forward.
And finally, Kevin, we're recording this in the middle of July 2023. What are your thoughts on what investors need to pay attention to for the rest of the year?
Well, Jay, I think it's the same thing that we were looking at the first half of the year. We still need to see inflation come down. It's still way higher than the Fed needs to see it. We need to look at employment like we just talked about. The labor market may need a little bit more balance for the Fed to be comfortable. And we want to make sure that corporate earnings hold up, because if corporate earnings hold up, that's going to be a really good catalyst for 2025. If they don't, because we're trading now on what could be an 18.5 multiple, possibly a 19 multiple on 2024 earnings. If they don't hold up, you can't ask for much more out of the PE ratios, at least from the multiple front. And those are things that we want to pay close attention to. And I think that's what the Fed's looking at. You know, they're saying they're data dependent, and heck, I believe them.
Excellent. To learn more about the DIVO ETF, please visit DIVOETF.com. Kevin, I want to bring in Tim Seymour, and let's have a conversation about the IDVO ETF, which is the Amplify International Enhanced Dividend Income ETF. Tim, appreciate you joining us for a conversation about international investing. Let's get started at a high level. When you look at the international markets for the first half of the year, what do you need to pay attention to?
Well, first of all, Jay and Kevin, great to be here. And I think having a conversation about IDVO after hearing a bit about DIVO is particularly interesting, because structurally, you're talking about a strategy that's trying to do the same thing, and yet we're doing it on an international basis, which is why Kevin and I are working together on this project. And I'm essentially working to advise CWP on this. The international world is really where I've spent the last 25 years of my career. And it's fascinating because I believe in long cycle investing, and international really has followed that. And this, you know, maybe I said this 5 years ago, maybe I even said it 10 years ago, but I actually think now is the time where international is finally starting to make that move on a relative basis to domestic markets. And for investors out there and advisors, it's not as if you're suddenly moving all the chips on the international line. It's about where you actually can find fantastic idea generation, and where you can actually be defensive and somewhat hedged, especially in a world where we think the dollar has peaked. So let's get to that macro look at international. And ultimately, to me, it does revolve around two or three primary things that anyone would be talking about. We might spend more time talking about the dollar, but you start with the Fed, and then you go to the dollar. And those two dynamics are critical for understanding where central bank policy is around the world. I would make an argument that the Fed is now the differentials between our central bank in the U.S. and other central banks is that the Fed will be the least aggressive of the major central banks over the next 6 to 12 months. I think Europe's farther behind the inflation curve. I think Japan has been almost in denial about inflation. And in fact, they would love some inflation. So what that means is the dollar is finally starting to make a move. As we record this in mid-July, the dollar's fallen 3.5% in 6 trading sessions. Now, you're not trading at home international markets. We're not trading them either. But the fact that the dollar is paying attention to some of the data flow that we've seen in the labor markets, and really where we've been getting data out of the U.S. that indicates that the Fed may, in fact, be 1 or 2 done. And the dollar will pick up on that. So investing internationally is often understanding where multinational companies derive their revenues. And IDVO as an international strategy is focused on companies that aren't necessarily deep in emerging markets. They're not necessarily companies that are all sitting in London. I mean, it's companies sprinkled around the world. Many of them have U.S. exposure, of course, and many of them also have exposure to other high growth markets. So when I think of the landscape that we're in now, by the way, this has been that recession, the new acronym we love on Wall Street. We bring up this up on CNBC. Actually, I said this the other night and people looked at me like I had three heads. Rhino. Which is an acronym RINO, which is recession in name only. And that comes after Tina, there is no alternative. So there's rhinos out there who believe that the Fed has magically engineered this 2% inflation target without a recession. I think that's not true. But I think you have an environment here where you've set the table for looking at other places, though, that might actually be a little bit stronger growth, places that I think do better when the U.S. is actually not necessarily hiking in their face. The U.S. is not going to start easing anytime soon, but international investing has got a really interesting backdrop here.
So, Tim, you mentioned emerging markets. When you're building an international portfolio, how do you weigh the risk reward of that allocation to the emerging market space?
I think you find companies that are in a cycle where, according to at least what this strategy endeavors to do, is those that are growing payout levels. So Petrobras, as we speak, if you look in the IDVO portfolio, is a name that sits near the top of the balance sheet. Petrobras at different points in its cycle has not necessarily been the poster child for corporate governance and efficiency, but they have been for the last couple of years. And there's an election cycle in Brazil, and there's some dynamics that could concern people. But this is absolutely an emerging market company. We are looking for opportunities to invest in emerging market energy companies and oil and gas and companies that I think even at we've seen this with Exxon, we've seen this with Chevron. With oil prices pulling back, you've actually seen the companies perform the underlying commodity. And at Petrobras, you have one of only a handful. And I would say it's a small handful of companies you can invest in emerging markets that give you oil and gas exposure. Russia's uninvestable right now. So you really have only a couple of places to go. But most importantly, Petrobras, their payout levels over the last couple of years, they've been paying out 100% of free cash flow, which is something that at times, the state has said, look, this is where actually investing on board with the state is your friend, because the state's also getting paid that money. They are the biggest investor in Petrobras. They want that money. Or we own, ICICI Bank in India. India is an economy that's actually going to be outpacing the growth of almost every other large Asian emerging growth economy. And this is a bank that to us is not necessarily that of an emerging market company. I mean, it's really it's debt ratios, it's pricing, and it's price to book, but the ROE growth there is phenomenal. So thinking about emerging markets in the context of international investing is absolutely, why not be invested in companies that have high exposure to growth? The portfolio is starting to add in some of the China big mega cap tech exposure that over the last few weeks, if you've been following the news flow, it's maybe a more interesting time, and it's a safer time to be investing in the China mega cap tech. So Tencent sits near the top of the balance sheet. It's about finding stories, not having to own them. Sprinkled around Japan, which most investors are aware is getting back near those highs from 1988. Boy, it's been a long time. But there's some really interesting things going on in Japan that I actually think it's going to continue, and it will overshoot. And that includes where there may finally be the end of deflation. There's some real important dynamics where the Tokyo Stock Exchange is forcing companies to have higher payout levels, higher ROE, higher accountability, better corporate governance, frankly, allowing a lot of these companies to re-rate. So when we own a Tokyo Mitsubishi Bank, UFG, in the portfolio, you're talking about the JP Morgan of Japan, that you're getting at 0.7 times book. JP Morgan trades 3 times that at a time when banks are probably in a very interesting position, especially if this yield curve targeting that the government's been all about for the last 5 years begins to wind down. It's a pretty exciting time. So it's just a smattering of looking around the world and finding those companies that fit a profile that they're in a position to pay a significant part of their free cash flow out.
So, Tim, with the reemerging popularity of international investing, I think it might be helpful for viewers to really get a little bit of an education on the ADR structure. So
Sure.
what are the benefits and the challenges of investing in ADRs?
Well, ultimately, if you're investing in an ADR, these are American depository receipts of international companies that trade on the traditional exchanges. What's good about that is the exchange requirements force these companies to be compliant on everything from accounting to certain types of transparency and liquidity. So there's no reason to be reaching into local markets. Whereas as a guy that when I ran my long short emerging market fund, it was sometimes it was really important to trade in those markets. I think for the strategy that IDVO is endeavoring to track, it's about finding those companies that can trade in ADR forms, which means that they're held to different standards. It means that we can buy them on typical exchanges. It means that there are options markets against them, and that's again a big part of what IDVO and DIVO intend to do, which is writing these covered calls. So that's really I think trying to take the mystery and destigmatize international investing is to say all investing is really a function of not only the companies you're investing in, but the neighborhood you live in, so to speak. And I say this all the time. I don't like to invest, or you cannot invest in a bad neighborhood. If and that literally means, yes, maybe a country's going through a political turmoil, or there's some dynamics going on that make a region a difficult investment. There's no reason to fight that. And again, IDVO doesn't need to have to invest in Brazil or China or India or other emerging markets that at times offer tremendous opportunities. So trying to again, as someone that had invested in funky places around the world, it's actually really a pleasure to be investing in the companies that are actually a lot safer, for lack of a better term, or to the extent that these are companies that are freely traded in Western markets. I think that de-risks a lot.
Hey, Jay, just to pick up on what Tim said on the option side, you can't discount the fact that we're able to use US-based listed covered calls on the ADRs. We're not going into these foreign markets and trying to find counterparties and be exposed to the inherent risk that may be there in terms of liquidity, as well as the currency risk. So his point about ADRs is incredibly powerful. And I want to highlight how much it translates into the option space as well, to our advantage, for sure.
Yeah. And actually, Tim, that was actually my last question for you around the options market in the ADR space. Could you speak to a little bit about the quality of the options market in the ADR space versus the regular standard U.S. options?
Yeah, I think underlying liquidity is it translates into options markets. So if you're talking about a mega bank in Japan, you're talking about an options market that's very deep. And remember, some of these Asian markets are much deeper from a trading perspective. But talking about some of the Brazilian options market, to use a term we talked about earlier on this podcast, this webinar, are kind of unstructured. So to the extent that we're able to be writing calls, selling calls in companies that the underlying liquidity is really what it is. And the interesting thing about the ADR markets is they are a reflection of both local market liquidity and what's going on in the ADR market. So you have kind of the combination. If a company's not liquid where it lives, it's not going to have a liquid option market. If it is, it's going to have a liquid option market. And I think that's, again, gets back to if you look at DIVO versus IDVO, IDVO is not trying to do anything any different in my understanding. I'll let Kevin speak to that, but the strategy really is about finding those companies that are well-known global players operating in the international arena, and that's what makes them different than companies that are in DIVO.
100%. We're looking for blue chip stocks around the world.
So, Kevin, you've been helping financial advisors build better portfolios for over 2 decades. When you look at diversified portfolios today, where would IDVO fit?
Well, Jay, you're complimenting me well beyond anything I deserve. I think I'm a lot older than that. It's probably been over 3 decades, but thank you nonetheless. I think that when we're talking about asset allocation and the importance of including international as a component now, especially to Tim's point with the dollar that may have peaked finally, looking at the ability for these companies to have incredibly robust dividends, very, very shareholder friendly. The allocation, if you're going to have to invest internationally, why not use the DIVO approach? Why not look for those stocks, strong balance sheets, earnings growth, cash flow, dividend growth, and then allow us to utilize these very robust US-based listed options to enhance that cash flow. I know that the cash flow yield on IDVO right now is in excess of 6%. It pays monthly, and it's a space that I think would be it would be a mistake for financial advisors to not have an allocation.
Excellent. So to learn more about the Amplify International Enhanced Dividend Income ETF, visit IDVOETF.com. That's IDVOETF.com. Thank you for your time, gentlemen.
Thanks.